Welcome, folks. It's time, so I'm going to get started. Any questions before we start? Okay, I'm not on video yet. Never mind. There you go. Today, we're going to finish the last of the loose ends. We're going to talk about complexity. We're going to talk about the debt you need to subtract out. We're even going to talk about equity compensation to employees, whether it's in the form of restricted stock or options. But now, a couple of things as reminders before I do that. Please do work on your DCFs, as I said my email at the end of last week. There's this one-time open window I will offer you at the start of next month. I think it's April 2nd, it's a Friday. If you can get your DCFs to me by that Friday, before, by 5, 6 o'clock in the evening, I will take a look and I'll give you feedback. It's not for grade. I can say, look, and not the kind of don't expect the kind of thing, or I think your revenue growth rate is wrong. I don't know enough about every company to tell you whether your revenue growth rate is wrong, but I can check your valuation for internal consistency, whether the assumptions you're making are at war with each other, right? So try to get that process rolling, because that's something that, if you put it off 2 months, then clearly the April 2nd window will open and close. It's completely optional. So if you feel completely comfortable valuing companies, just go ahead and value the companies. But if you're not, it's a good time to kind of get feedback. So let's get started. Today's class, we're going to talk about the rest of the loose ends. So the test for today is about those loose ends. So let's start with the first test. You've valued a publicly traded company. You've taken their operating assets. You come up with a value of 100 million. There's no cash in the company. The company has debt outstanding with a face value of 100 million, but the market value of that debt is only 80 million. So ready for the question? Matthew Newber, you're going to be the person I put on the spot here. So I've got 100 million value for the firm and this debt, which has a book value of 100 million, but a market value of 80 million. What's the value of equity in this company? 20 million, 0, or some number in the middle?
20 million.
And you got the 20 million by subtracting out the market value of debt from the value of the operating assets. And that's what every valuation textbook will advise you to do, subtract out the market value. But let me throw a curveball at you. Why is the market value of debt less than the book value of debt?
I assume it's because of the credit worthiness of the company.
The credit standing of the company, right? So let's say an acquirer comes along and decides to buy the company, and the acquirer has a good credit standing. He's a AAA rated company. What's going to happen the minute that company announces it's planning to buy this company?
So the debt will rise towards the par value.
The par value, and the value of the equity will go to 0, right? So what I'm trying to do is there's a gray area here, which is, you're right, you subtract out the market value of debt, but depending on what you plan to do with the company, you could very quickly start to see that change, because that market value of debt is a function of credit standing. And if somebody's acquiring the company with a different credit standing, that could very quickly alter the value of equity in the company. Nothing changes, radically, but it's something to keep in mind. Let's do a second issue. And this is something we're going to talk about today. Let's say, Aaron, you're going to be the one here. Let's say you value the equity in a company at $1 billion. You took free cash flows to equity, discount the cost. You did everything right. You come up with $1 billion for the equity. There are 100 million shares outstanding. So let's start with the easy one here. What's the value per share?
It's $10 a share.
$10 per share, right? Billion in equity divided by 100 million. Now I said, I forgot something. This company just granted 10 million options to its CEO. The strike price of these options has been set to 10. Will that affect the value of equity per share that you've just computed?
Yes, I imagine it would, but I'm not sure exactly how.
You know why I set the strike price at $10, right? I gave you an escape hatch because the strike price is equal to the stock price, and the old accounting view of options is very rigid, which is, if you granted options at the money, the accountant says, don't worry about it. Your value per share is not affected. You see how the reasoning worked, right? If I exercise these options, really, I'm exercising at the fair value, so who cares? which is a completely wrong-headed view here. And you can see why. Even though the strike price is set at $10, if I issue options that are at the money, and there's 10 years left on the option, will that option have value? Even though it's at the money now, given that, yeah, there's time premium, right? You go to the CBOE, you try to buy an at the money option, you refuse to pay. Trust me, you're not getting any options today. Accounting has come to its senses on this, but for a long time, accounting made the mistake of treating options that were at the money as, who cares? But you can see as a stockholder in the company, you're clearly worse off now that you know that there's 10 million potential shares out there and that this CEO will exercise the options, not today, but when the stock price goes to 18 or 20, he's going to wake up and say, you know what, I'm going to buy my 10 million shares today. Today, we're going to talk about how to bring in the value options outstanding into your value per share without using bludgeon approaches, which is just changing the number of share count, or, which is what a lot of people do. We'll talk about ways to do it right. So let's close this up and go back to where we were in the lecture notes, because we were talking about complexity. Okay? So let's talk about complexity. If you remember the example I gave you, and I think this is where I left you, at the end of the class, I said, what if I gave you two companies, one simple, one complicated, the numbers look exactly the same. I think we collectively decided that the more complicated companies should trade for less because you don't want to be exposed to all that additional risk. And the question I left you with is, how do we measure complexity and how do we bring that complexity into valuation? So when I threw this out to the class in the semester that this came up in 2000 after the Tyco fiasco, when I said, how do we measure complexity? They threw it back to me and said, why don't you do it? You're teaching the class, why don't you do it? So I gave them my first shot. And as I said, they were not impressed. Here's what I did. I counted the number of pages in these were the days where you actually got physical 10Ks and 10Qs. I counted the number of pages in the 10K and the 10Q. I know it's extraordinarily simplistic. But I just counted the number of pages. Staying with the simplistic measure, with these 10 companies, which of these 10 companies would you least want to value? I know which one I would not want to touch. Which of the 10 companies is most daunting to you? Hey, take a look at Citigroup. 1,026. This isn't War and Peace. This is how many pages it took Citigroup to tell me what happened in 1 year. It takes you 1,000 pages to tell me what happened last year to your company. You're one heck of a screwed up company. So I put this up and everybody in the class says, look, we're not paying 150. At that time, it was a little cheaper to get an MBA. It was only 150,000 rather than the 200,000, whatever it is today. We're not paying 150,000 to count pages in a 10K. We want something more sophisticated. I said, you're right. What was I thinking? I'll be back next week. And I came back next week with what I call my valuation shit list. You heard me right. These are the things that bug me the most when I value a company and how much it's a purely subjective judgment. But I made a list of everything that bugs me when I value a company, how much it bugs me, and then I built a spreadsheet that measured how much I got bugged. I'll give you examples of things that bug me. A company that claims to be geographically diversified but doesn't tell you where. So what the heck did he throw that in for? Or it tells you where, but you don't recognize any of the parts of the world they claim to be in. I still remember about 20 years ago when I first valued BMW, I was looking at the breakdown of revenues. And they had North America, South America, Europe. In fact, they had Europe, Middle East, and Africa. Don't ask me why they bunch up all those things. They had Asia, and then they had Oceania. And I'm thinking now, so where the heck is Oceania? Maybe it's the lost continent of Atlantis. They're selling a lot of cars there. So finally, I gave up and I called the investment relations officer for the company. And she said, well, Oceania is Australia, New Zealand, and Indonesia. And I said, why would you bunch them all together? So because they're all by an ocean. But the problem is once you bundle those three together, how the heck am I going to decide which country risk premium? So I made a list of things that bug me, how much they bug me, and I put it up there. And I said, do you like this more? And they said, this is much better. This is what we get an MBA for, is to build spreadsheets like these. And I said, that's nice, but there's one cost to using the spreadsheet. The higher the score, the more complex you are as a company. I said, to get the score for Citigroup, what do you need to do? You need to read 1,026 pages. I said, I'm not doing that. But each of you is valuing a company this semester, right? They could see the train coming at them down the tracks. There was nothing they could do at this stage to get out of the way. They said yes. And I said, this semester, in addition to valuing your companies, why did you come up with a complexity score? They bitched and they moaned, but what choice did they have? They should have just taken my page count and moved on. But since they made an issue of it, they came back with the scores. And that semester, in addition to valuing their companies, they came back with a complexity score for their companies. It's interesting because here's what they found. They found almost no correlation between company size and complexity. I thought they would find that larger companies were more complex than smaller companies. They didn't find that. They did find that emerging market companies were about 20% more complex than developed market companies, usually because of cross-holdings. They found that companies that grew through acquisitions were significantly more complex than companies that did not. You know why? If any of you are valuing companies that do acquisitions, you see the accounting blind spots emerge, right? Goodwill, impairment of goodwill, acquisition charges, the kind of noise that throws into the financials. And finally, they found that any company with a financial arm was automatically more complex than one without a financial arm. Saying, what are you talking about? I'm talking about GM, GMAC, Ford, Ford Capital. Why? Because if you have a financial arm embedded in your company, it's like having a bank in the middle of your company, and you have to decide where the bank ends and the company begins. And that semester, this is 2001, the company that they came back with as the most complex company in the world was a no-brainer. Think about a company that grows through acquisitions, has a financial arm, is in multiple countries, multiple businesses. You know what they came back with, right? GE was the most complex company. I've told people that if I were the devil and I were in charge of designing hell, and there was actually a special subsection of hell for investment bankers, I would like to be put in charge of that subsection. Because here's what my torture would look like. The banker would arrive from his place on earth, and of course he's pissed off, he's in the wrong place, he didn't expect to be here. And then he comes to terms with, hey, here's where I am, what do I need to do? And I tell him, you've got to value GE. Not just once, but over, this would be like Groundhog Day. You've seen Groundhog Day, right? This would be like Groundhog Day. Every day you wake up and you value GE over and over and over again for the rest of eternity. I can't think of a fate worse than that in hell. Complexity is partially thrust upon you, but it's partially by choices you made. Citigroup ended up as a 1,000-page company. You know why? Because the day that Citicorp and Travelers Group came together, what did they promise the world? We're going to be all things to all people, an insurance company, a real estate company, a bank. So basically, they designed this financial supermarket, and with that came a consequence. They create one of the most complex companies in the world. So measuring complexity, if you like the score, you can go ahead, but remember, to come up with the score, you really have to read the financials. A final piece, once you've measured the complexity, what do you do with it? You got to bring it in somewhere, right? Remember the IT proposition. For it to show up in value, it's got to show up either in the cash flows or in the discount rate. How would I show complexity in the cash flows? One way to do it is to actually haircut the earnings, saying, look, this is a complex company. I'm going to be much more cautious about estimating earnings, but it's completely arbitrary. I'll give you my favorite device for dealing with complexity. One of the drivers of whether growth is valuable is what kind of return on capital you think this company can make in the future. We made a big deal about return on capital. Let's suppose you have a company with a return on capital of 20%, but you look at the company and you have no idea how it makes money. It doesn't describe its business model. It's got special purpose entities, but you just see a high profit and a high return on capital. You're not even contesting that they made money last year, but here's what you're asking. If I don't know how they're making money, can I keep assuming that they can keep doing it in the long term? I certainly can. So when you have a company which is complex, one of the ways to punish it is to bring the return on capital down towards its cost of capital much more quickly. I remember the late 90s, one of the companies people used to like to value because it's such a superstar company was Enron. This is well before we knew the Enron scandals. To a person, every person who picked Enron to value would come in and say, you know what? I can see they're making money, but I have no idea what they do. They called themselves an energy trading company, but what the heck does that even mean? Who are they buying the energy from? Who are they selling the energy to, and why are they making money? And my reaction was, hey, if you don't know how they're making money, don't assume they can keep doing it. So well before the scandal, people were coming up with values much lower than the price because they said, look, we don't know what the company does. And if you feel up to it, ultimately, you can try to adjust your cost to cap for complexity. In fact, I told you I spent a month on each of these loose ends. One of the things I came up with was an implied cost to capital. Remember how I did implied equity risk premiums? I broke the S&P 500 into two halves, 250 simple and 250 complex. And so there's some judgment call there, and did an implied equity risk for each half. And I found the implied cost of capital for the risky half was about 1% higher than the implied cost of capital for the safer half. And finally, as a throwaway, towards the end of the paper, I ran a regression. You've seen regressions, right? You're trying to explain something with something else. I took price to book ratios for the 100 largest market cap firms, and I regressed them against return on equity, growth, and beta. Three standard variables, and we'll talk about this more when we do pricing that you'll see. But then I threw the number of pages in the 10K into the regression. You know what I found? A coefficient of minus 0.003. Think about what that tells you. Every 100 additional pages in your 10K lowers your price to book ratio by 0.30. Companies, when they're complex, care away investors. In good times, we might not notice. In 99, nobody cared. But by 2002, a lot of people cared. In 2021, nobody might care. We're in a buoyant market. Everything is getting pushed up. Nobody might care that you have a complex company. But this too shall pass. There will be tough times. And if you're complex, those are the times you're going to say, I wish I were a simpler company. Any questions about complexity? So the key to remember is complexity is not always thrust upon you as a company. Some of it is self-inflicted. Some of it comes from accounting trying to help too much. You know what I mean by that? All these disclosure laws, even though they're trying to make companies more transparent, often make them more complex. And you have to find this middle ground and decide what complexity to worry about and what to kind of ignore. So we talked about complexity. Let's move on to debt. When we did cost of capital, I came up with a very simple rule on debt. I said, be careful about what you call debt. And I included all interest-bearing debt, short-term as well as long-term, and lease obligations. And as I said, stop there. Don't keep adding things to this, underfunded pension obligations, healthcare. Don't throw them all into debt. You say, but I'm just trying to be conservative. I said, that's exactly why you don't want to throw them into debt, because if you throw them into debt, here's what's going to happen. Your debt ratio is going to get higher. Your cost of capital is actually going to get lower. That doesn't strike me as being conservative. So when you do cost of capital, you want to be narrow in your definition of debt. You want to count in only interest-bearing debt and lease commitments. That gives you cost of capital. Use the cost of capital to come up with an intrinsic value for the firm. And then you revisit debt and you say, which debt should I subtract out? And today's starting point was, hey, we talked about book value and market value. And while every valuation textbook asks you to use the market value, do so with a grain of caution, which is that market value for equity then reflects your credit standing for your company. And as the credit standing improves, if your value for the assets does not increase proportionately, you will actually end up losing value as an equity investor. So I'm not changing the conventional practice. I'm just saying use it with caution when the reason your equity is worth a lot of money is because your market value of debt is a big discount on your book value. And if you're liquidating the company, don't even talk about market value, because if you liquidate the company, the banker is not going to say, I'll take half of whatever you owe me He's going to insist on being paid the entire amount. So liquidation valuation, it's always book value that you look at because you got to pay off the entire debt. But one final thing, before you decide to move on, look around. Look around to see whether there's anything else you need to net out as an equity investor. Remember, this is your last chance. Like what? If you have underfunded pension obligations and healthcare obligations, this is a place, I told you not to include them as debt for cost of capital, but you might net them out to get to value of equity. Why? Because your equity is worth less. If you're the target of a lawsuit or lawsuits, this is where you get to subtract out. So if you're valuing a tobacco company for 30 years, this has been practiced, right? You do a DCF, but then you got to factor in expected payouts because of lawsuits. Of course, people have moved on from tobacco. Their hot new sector, if you're staying in the same kind of business as cannabis. If I value cannabis stock, you know what? I'm going to build in an expected liability because even though nobody sued them yet, we know it's coming. It's almost guaranteed. It's part of this business. It's not because, they're bad companies or good companies, but that is part of the game. And I'll give you an example of a company where I valued this company about 4 years ago. And it's right after they did a big acquisition. And they really bought themselves a heap of trouble. This was when Bayer bought Monsanto. Those of you remember, this was actually one of the worst acquisitions of all time. Bayer CEO decides to buy Monsanto for its animal feed business. They wanted to kind of increase their market share, all nice. But when they bought Monsanto, they also bought themselves thousands of lawsuits. You know why? What did Monsanto make that's made them a target for like thousands of lawsuits?
Roundup.
Roundup. So when Bayer bought Monsanto, the minute they bought them, they bought all these lawsuits. And I don't know what they were thinking. Because these lawsuits were not tens of millions, they were billions of dollars because there was, think of every lawn in suburban America, has been maintained with Roundup and all those people walking on those lawns, working on those lawns. They're all potentially part of this class action lawsuit. And for years, that was what was dragging down Bayer's stock price. So when you valued Bayer, you had to factor in A, how many of these lawsuits they'd lose, and B, collectively what they'd have to pay out. You think, how the heck am I even going to estimate it? I tell people, get a good trial lawyer friend. I've tried doing this economically. There is no rational way in which you can sit at a table and say, let me estimate the probabilities. You got to understand the ins and outs of how these lawsuits work through and how settlements are arrived at and what happens when you have a class action lawsuit. But in some companies, that then becomes the driver of equity value. So any questions on debt? So think narrowly when you do cost of capital, think broadly when you subtract our debt to get to value of equity. And you're already going to see that you can have two very different debt numbers. Which brings us to the final loose end I want to focus on, which is when you decide to use equity to compensate your employees. For many of this is not an abstraction, right? I'm sure some of you are going to work for tech companies, especially younger tech companies, and your package with which they attracted you to the company has shares or restricted shares or options. So let's start with the question. Why do these companies give you options and restricted shares? Mattia, what do you think the reason is? Why do they give you shares?
I think they want to give you a longer term incentive that doesn't cost them as much cash up front.
Well, the longer term incentives are kind of a very low part of the story. It's because they don't have the cash. Let's face it. An Airbnb cannot pay what Goldman pays right now as an upfront salary because they don't have the cash. That insight is going to become very useful when I talk about what do we do about options. Options are part of a compensation package because these companies don't have the cash to compete with other employers, so they offer you equity in the company. So there are two questions we're going to have to deal with here, because this is not a side story anymore. For the last 30 to 40 years, increasingly compensation packages, especially in some sectors, have become weighted with equity. restricted stock and options. We have to talk about how those options and restricted stock that have already been granted affect your value per share today. But we also have to talk about how do expectations about future grants affect your value per share today. I want to separate the two. So let's start with restricted stock grants. Do any of you own restricted stock in any of the companies you used to work at? No? Do you know what when it says restricted, clearly it comes with the restriction, right? So when you go to work for a tech company and they give you restricted stock, what's the restriction on? So here, what's the restriction on?
I think you need to work a certain number of years before you
First,
can.
you got to get vested, which is,
Yeah.
even though they give you these options, you can't quit tomorrow and walk away. So you got to get vested.
Mhm.
That's the first half of the restriction. What the other half is, even after you get vested, you might have restrictions on how long you hold the shares. You might not be able to sell the shares for 3 years or 5 years. So restricted shares are regular shares with restrictions on trading. So let's say you have a company, you come up with a value of equity and you're trying to decide what share count to use, right? So you open up Airbnb, they give you a share count, but strangely, in their share count, they don't include restricted shares. I've never understood this rationale. They'll say, so if you read the prospectus, they say, we have 23 million shares. Oh, by the way, we haven't included the following, the 3 million restricted stock units we've offered it. Their justification, I guess, is, hey, some of these people might not get vested, so we're not going to count the shares. But let's face it, that's an incredibly casual way of dealing with restricted shares. One way to deal with them is to bring in the probability that you will not get vested and try to adjust those shares because they're real shares outstanding. This is not some made up stuff. These are shares outstanding. But let's face it, when you think about a company with 3 million restricted shares outstanding, who holds most of these 3 million shares? It's not the guys at the bottom of the rung, it's towards the top. If you look at these restricted shares, they're actually very heavily concentrated in 7 or 8 or 9 people at the top of the management. Do you think those guys are going to hang around to make sure they vest? Absolutely. Do you see where I'm going? If you don't want to make assumptions about vesting, I would go ahead and count all the restricted shares because in my experience, unless the company crashes and burns, those restricted shares will become actual shares. So with restricted shares, easier challenge is, hey, just count the number of shares in your share count, move on. There might be restrictions, but there's still shares outstanding. The more difficult challenge is what to do about options. You know why, right? Options are neither shares nor non-shares. What do you get with an option? The right to buy a share at a fixed price. And the reason options matter is because you gave that fixed price. If you just gave employees the option to buy shares at whatever the prevailing market price is, nobody would care. And because they're at a fixed price, they will get exercised only if the market price is much higher than that strike price, right? No employee in his right mind will choose to exercise options if the exercise price is 20 and the strike price is 3. So they will choose to exercise the option, which means you're either issuing the shares at a massive discount, which effectively affects every other shareholder of the company, right? Because everybody else is paying 36, this person pays 20. Or in some cases, you will actually use cash flows from your company to buy back shares to have to give to them. But that just still has the same issue. The reason options are troublesome is you can't count them in share count today because they might never get exercised, but you can't ignore them either because there's a very real chance they will be exercised. So I'm going to take you through a very simple example. I'm going to start with what I call the bludgeon approach to dealing with options. And I'm going to give you a slightly more refined approach, which a lot of analysts use, called the Treasury stock approach. And then I'm going to talk about what I think is the right way to deal with options. So let's set up an example. A company has 100 million in free cash flows growing at 3% a year in perpetuity, 8% cost of capital. So if you think about 100 million growing at 3%, 8% cost of capital, the present value is $2 billion. It has $1 billion in debt. The difference, of course, billion is the value of equity. So 100 million shares, the value per share is $10. Now I throw in what I threw in at the starting quiz. This company decides to issue 10 million options at the money. At the money basically means the strike price is set equal to the stock price. The question I asked was, how will it affect your value of equity? And Erin very rightly pointed out that as an equity investor, she feels less wealthy now than before I told you, because you now have these 10 million options hanging over your head. So let's see the different ways in which people try to bring this 10 million. Here's the bludgeon approach. Here's what they do. They say, there are 10 million options. I'm going to assume that they will all get exercised in the future. And if they get exercised, the share count will become 110. Remember, there are 100 million shares. Just add the 10 million options. This is called the fully diluted approach to dealing with options. And you're trying to use the share count to bring in the options outstanding. You know why this is so completely unfair? You're acting like the options will be exercised, right? But if they're exercised, what does the person exercising the options have to do to get the shares? Dave? Let's see. What would you have to do if you decide to exercise? Let's say you decide to exercise the shares, the options today. You're going to get 10 million shares, but what would you have to pay me? You have to pay the exercise price, which would be 10 times $10, which is 100 million. That's going to come in as a cash inflow. I'm completely missing that. So you know what's going to happen if I use the fully diluted approach? I'm going to systematically undervalue the per share value, because I'm acting like exercise happens, but I collect no money. So there's an easy fix for that, right? The Treasury stock approach takes the easy fix. What happens when you exercise? You get 100 million in cash. That's the 10 million shares times the $10 exercise price. It adds 100 million to the value of equity you got, which is $1 billion. And then divides by the 110 million shares, and magically it says, nothing will happen to your value per share. This was the accounting gain, which is why we worried about share count when you have options or at the money, because exercising them will have no effect on your value per share. And as Erin and I talked through, I mean, this is the flaw in this reasoning, is you're assuming that an option at the money is worth nothing. So I'm kind of leading you to the right thing to do. When you give me an at the money option, have you given me something of value? If you give me 10 years to play this, of course you're giving me something of value. If I can estimate how much that value is, you know what you've done? You've taken a portion of your equity and given it to me in the form of options. So here's the third approach. I'm actually going to value the options as options. What does that mean? I'm going to take the strike price of 10, the stock price of 10, but then I'm going to bring in the fact that I have 10 years to play this game and the riskless rate and use an option pricing model. And if I can do that, I value the options. I'm going to take the value of the options out of the $1 billion in equity that you have as a company, essentially saying you gave away the equity. And once I've done that, I'm going to go back to the 100 million shares outstanding, because I don't care about share count anymore. When you value the options, you've effectively computed the expected value of these options being exercised in the future, taking them out of the value of your equity. We've always known this with employee options, but for a long time, people fought using option pricing models here, with some good reasons. Traditional option pricing models were never designed to value this kind of option. You're saying, what kind of options they're designed for? They were designed for the options issued in the CBOE, where the company was not involved. You exercised an option, the company had nothing to do with it. But these options were issued by the company. They were long-term, and they came with restrictions. So people said, you can't use a Black-Scholes model to value these options. And you're right, you cannot use a Black-Scholes model without adjustments to value these options, because these options, when they're exercised, will create dilution. You know what I mean by dilution? When you exercise these options, the share count actually would change. Whereas if you go to the CBOE and you exercise an option, nothing happens to your share count. But we've also had 30 years to build variants of the Black-Scholes option pricing model to build in this likelihood. In fact, the other thing that happens with employee options is, well, with traditional options, you tend to hold through expiration. Why? Because you can always sell the option at a higher price. Employee options are illiquid. And because they're illiquid, if the stock price shoots up a lot of employees, even though there's time left in the option, will choose to exercise. So if you're a Tesla employee, you are crazy not to exercise your options when the stock price hit 900. Even though you have 6 years left, because this is you're at a point you might not see over the remaining 6 years. So here's what I'm going to do to adapt employee option pricing model. So basically, I'm going to take the Black-Scholes model. I'm going to adapt it. For what? I'm going to adapt it for dilution. It's actually fairly simple to do. Instead of using the current stock price as the S in the model, I'm going to adjust the current stock price for the fact that if these options get exercised, the stock price will immediately drop. So it's built into the model. So what I do is I adjust for dilution. Instead of using the $10 current price, I use the 958. The way to think about the 958 is if these options get exercised immediately, the stock price will drop from 10 to 958 because you've diluted the options. I use that lower S to value the option. So basically I'm saying an employee option is worth less than an otherwise similar options that you might buy in the CBOE without the dilution effect. And if I'm really worried about the fact that employees have to exercise early, here's the quick fix. Typically, we value options through maturity, right? So if there's a 10-year maturity, we use 10, T is equal to 10. But if I'm worried that employees exercise their options early, and let's suppose I could tell you a statistic, and this is actually based on fact, that employees traditionally exercise options halfway to maturity with employee options. You know what I could do? Take the 10 years and make it 5. It sounds like you're doing these makeshift adjustments, but it's actually fairly sensible adjustments. You now have an adapted version of a Black-Scholes or a binomial option pricing model adapted for employee options. What that gives you then in this case is a value for the option of $5.42. So remember that at the money option that my accountant said, don't worry about it. When I gave 10 million options to my CEO, at $5.42 an option, I've given away $54.2 million of your equity to the CEO. So I'm ready to finish my evaluation. I take the $1 billion equity value. I subtract out the 54.2 million, which is the value of options already granted to my CEO. I call this the dead weight cost of options. I divide by the number of shares. I get a value per share of $9.46. So Erin's instincts were right. When I gave the option, she felt poorer. I've now told her, look, you really are worth only $9.46. So what's the first thing you need to do when you value equity in a company? Check the footnotes for options outstanding. It'll be in the footnotes, and they'll tell you how many options are outstanding. They'll give you an average exercise price and an average remaining maturity. Every one of my valuation spreadsheets has an option spreadsheet built into it as a worksheet, precisely for this reason, because if you have options outstanding, I want you to feed those numbers in the option, value the option, and net it out to get to the value of equity. This value that you get will be lower than the value that you got with the Treasury stock approach. And you know why it's lower? Because you're giving a time premium to the option, which is the right thing to do. You know why options became such a big way to compensate employees in the 1990s? Because that's when they took off. You know why companies shifted to options? Because Congress, in its instinct to do the right thing, often does the wrong thing. In the early 90s, Congress decided that top management was making too much. Does that sound familiar? I keep hearing the same thing now again, right? CEOs are making too much. And they decided the way to curtail it was to put a limit on how much CEOs got paid. So they built this, everything in Congress is elaborate. Who in Congress writes a simple law? They write this elaborate law listing out all the ways that companies were paying employees then, which was primarily through salaries and bonuses. And so they put in all these restrictions. You can't do this, you can't do this. Well, this will be counted towards a cap. But they forgot something very important, which is options, because nobody in 1989 was using options to reward employees, so they left it out. So if you paid with options, it kind of was not in the law. So guess what companies did right after the law was passed? They said, okay, we'll follow all your rules. We won't pay bonuses. By the way, we'll give 50 million options to CEO. You never counted that. That's why sometimes you have to worry about laws passed with the best of intentions, because while they might solve the last problem you had, they create new problems. And from the early 90s through about 2007, options were out of control. Out of control in what sense? Boards of directors would give hundreds of millions of options to the CEO. And they say, what's the big deal? We gave out the money options. Our accountant tells us we gave away nothing. So for 15 years, the use of options was aided and abetted by accounting practice that was downright stupid. Because accountant was saying, just give options, not a big deal. Your earnings are not affected. And I remember, I was all these panels between 92 and 2007. My question was, what the heck are you guys doing? How can you tell boards of directors that they're giving away nothing when they're giving away tens of millions of options that are at the money? And technology firms clearly did not want to change the law. But eventually common sense wins out. You cannot keep doing it. If what Warren Buffett said in the late 90s clearly rings true. He said, if options are not compensation, what the heck is? And if compensation is not an expense, why would we even care about it? He said, this is an expense. So finally in 2007, guess what companies were required to do? When they gave 10 million options like they did here, that year you had to show a $54.8 million expense in your income statement. All of a sudden, the incentives to give options went away. Starting in 2007, you've seen a shift away from options to restricted stock. A much simpler, much clearer. I prefer restricted stock, actually. It's cleaner, it's more visible. You're not playing games. But you can see how accounting practice can sometimes lead companies to do what they do. But today, when you see the cost of goods sold for a technology company, in those cost of goods sold are the expenses associated with the granting of restricted stock and options, stock-based compensation. But to show you how stupid the world is becoming dealing with stock-based compensation, have you guys seen the adjusted EBITDA calculations these companies put out after they do their income statement, subtracting out compensation? What do the Airbnbs and the Ubers and the Teslas do? They compute an adjusted EBITDA. And what do they do for the adjusted EBITDA? They add back all of the stock-based compensation. And there are analysts stupid enough to let them get away with this. We spent 15 years trying to get companies to do the right thing and accountants to do the right thing. And what are we then doing? We're reversing the right thing and saying, let's go. It makes absolutely no sense to me, because this is clearly an expense. And don't tell me that this is not a cash expense, because you just skipped a step, right? If you took those options, issued them in the market, raised money from the market and paid it out to your employees, I would treat it as a cash expense. So don't fall for this, let's add back stock-based compensation. It is true you get a little bit of a tax break now relative to the old times, because these expenses are, in a sense, tax deductible expenses. Well, so you get the tax benefit now instead of waiting till they get exercised, which is what the old law used to be, is until they got exercised, you can get the tax benefit, which meant that you might have to wait 12 years to get a $500 million tax benefit. This way, every time you grant options, you get a tax benefit, which also means that if you build it into your expenses, it's already in there, right? You get EBIT, you do 1 minus T, you're building in the tax benefits. One final point about this before we move on. So let's say you value a company with a lot of options outstanding. Okay, good. You're done, you finish the valuation. You deal with the existing options outstanding. Here's something to think about. Your company is not quite done. It will issue options in the future. Why? Because it doesn't have the cash. So you valued Uber and Airbnb. I promise you that cost of goods sold next year, 2 years out, will include option grants to employees, because that's how they pay employees. And today's day and world, this is becoming easier to do, because if you take the existing expense of a company, which already include options, and you project out margins, you're in effect building in that these expenses will continue in the future. But for some people, this seems like double counting. I often get asked, isn't this double counting to reduce the value of my equity for the value of options outstanding and to lower future earnings for future option grants? And my response is no, because I'm counting for two different things. When I subtract out options outstanding there, and I bring that into my value, I'm counting in options you've issued in the past. When I reduce future earnings, it's for options you plan to issue in the future. And you can think of a company which has decided to stop using equity-based compensation, in which case all you will have is the dead weight cost. You won't have the future expense. Or a company that's never issued options in the future that plans to do it in the future, in the past, but plans to do it in the future, in which case you might have no dead weight cost, but all future income is lower. So don't think of it as double counting. You're dealing with two separate issues. The dead weight cost of options deals with options already granted, lowering future earnings for expected future option issues, and is counting option grants you might make next year, 2 years out, 5 years out into perpetuity. One final point about options. When you think about option pricing, when do options have the most value? When there's a lot of volatility and when the options are long-term. You know what makes employee options particularly deadly? What types of companies issue employee options? Generally risky, young technology companies. So what's going to be true? They'll have high volatility, right? And these are 10-year options. You're going to be shocked at what a 10-year option, even if it's out of the money. So don't make the mistake of saying, this is an out of the money option, I'm not going to count it. So if you have an option at Tesla with an exercise price of 800, for God's sake, don't ignore that option, because even though the stock price is 600, that option is significant value given the volatility in the stock. So count all options outstanding, value those options, net them out of the equity value to come up with the value per share. Any questions on any of the loose ends? So now let's go back to something I talked about at the start of the class, where I said a good valuation is a bridge between stories and numbers. And what I said then was every number in your valuation has to have a story attached to it. And every story you tell about my company has to have a number that goes with it. And I promised I would come back and make this more concrete. So here's what I'm going to do. I'm going to take you through a 5-step process that I use to value companies. You're saying, why 5 steps? Because I'm a number cruncher. To me, I have to think in linear terms. If you're not a number cruncher, you prefer to do a fuzzy, steppy process, that's fine with me. But for me, this is what works when I sit down to value companies. And I'm going to use an example to kind of illustrate how the story plays out. The example I'm going to use is an old one, but the one I'm going to go back to is it's actually where I learned to perfect or get better. Perfect is the wrong word. Get a little better at the storytelling part of my valuation. So valuation I did of Uber in June of 2013 or June of 2014. So let's suppose I want to value Uber, June of 2014. I need to tell a story. To tell a story about a company, what's the first thing you need to do? You need to understand what your company does. I still remember when I valued Beyond Meat when it went for its IPO. The first thing I did was I went to the grocery store, to the frozen food section, and bought a Beyond Meat product because I wanted to see what it was that this company did that made them so attractive to so many consumers. And it really is, almost disgustingly like meat. The reason I say disgusting is I'm not a great fan of, of raw meat. And Beyond Meat is like eating a burger that's a little rare. So for me, it wasn't that appealing, but I could see why somebody who really missed their raw burgers but was feeling conscience-stricken about how beef was affecting global warming might like Beyond Meat. But you need to understand the company, you need to understand the market it's going to go after, and you need to understand its competition. So let me go back to June of 2014 and tell you how I got interested in Uber. In June of 2014, I opened up the Wall Street Journal, I think it's June 2nd or 3rd, and I noticed an article about a company called Uber, a company I'd never heard of. He's like, how can you not hear of Uber? I lived in New York City. I took the subway. I never took car service. To me, Now, in fact, let me take that back. I'd seen the word Uber on my credit card statements in the 3 months leading into June of 2014, because it turned out that my second son was going to college in North Carolina, was using Uber and using my credit card to back it up. Don't ask me how that happened. But I thought he was taking German language classes, to be quite honest. I had no umlaut on the U, should have kind of given it away. So I read this news story that says a company called Uber had raised $17 billion, $3 billion from venture capitalists who had priced the company at $17 billion. And I was shocked. I was shocked that a company I'd never heard of had a $17 billion price tag. So what's the first step in valuing Uber? I need to understand what Uber does, right? So guess who I called first? I called my son in North Carolina. But he was still sleeping. It was only 11:30 in the morning. He kept what I call college student hours. You know what those are? You go to bed when you feel like going to bed. You wake up when you feel like. It's got nothing to do with the sun rising or setting. And he wasn't answering his phone. So then I called my niece who lived and worked in Chicago, and she had to be awake because she had a job. She was technically awake. What that meant was she was at her desk, her eyes were open, but a horrifically bad mood. She picks up the phone, she says, "What do you want?" This is how she greets her favorite uncle. I said, "Have you heard of a company called Uber?" She said, "It's a ride-sharing company." I said, "What the heck is a ride-sharing company?" She said, "I don't have the time to tell you right now. Why don't you just download the app and find out for yourself?" Hangs up the phone. Should talk to her mother about this behavior. But I did download the app. I'm sitting in my office in New York. I hit the Uber app on my phone. Magical things start to happen. Or GPS opens up. I can see a car trying to drive towards me. You know why trying, right? In New York City, you don't get from point A to point B. You just try. A lot of one-way streets, block streets. You can see the guy zigging and zagging. And I can see his name, George. This has never happened to me with a yellow cab. Fascinated at what George and his car navigate their way to 44 West 4th Street. He pulls up, and then I run out of the car and say, "Hi, George." He says, "Where do you want to go? You didn't put a destination." I said, "Nowhere in particular. Can you drive me around for about 30 minutes? I have some questions to ask you." He paused for a moment briefly, saying, "What if I'm a serial killer?" But I guess he looked at my size and he said, I can take this guy, get in the back." And I got in the back and I started asking him questions. I said, "Is this an Uber car you're driving?" He said, "No, this is my car." I said, "Are you an Uber employee?" He said, "No, I'm an independent contractor." I said, "Why do you do this?" He said, "I have a regular job. I don't make much money on it, but I already own this car and pay insurance on it. And Uber allows me to make a second income on the car." And I said, "Why do you need Uber?" He said, "In New York City, it's illegal to stop on the street and offer people a ride. Uber connects me with customers." I said, "Okay, I understand now why you use Uber." 30 minutes later, it drops me back off at 44 West 4th Street. I get out of the car. I offer to pay him. He should have just taken the money. He said, "You don't have to pay me." I said, "It's free?" He said, "It's not free." "When you downloaded the app, did you enter your credit card?" I said, "Yes." And he said, "They'll charge you." And I said, "How do you get paid?" He said, "They send me 80% of your fare." I said, "Why 80%? He said, "I don't know. That's what they all do." And he drives off. At this point, I could see why Uber did what they did. By connecting cars to customers, they got to keep 20% of the fare. So here's what I did. This is the research, if you can call it that I did. Basically, talk to people about Uber, try to understand them. I drew a picture, and I try to do this, especially with companies where I don't quite understand what the company does. So basically, in this picture, what a question was asking was, what do drivers get out of Uber? They get to connect to customers, they get a car or to make money in a car they already own, and they get to earn a second income. What does Uber get out of this? 20% fare. Which left me with one final question. What do customers like about Uber? Why do people like my son and my niece like Uber? So I decided to call my son again. This time at what I thought was a civilized hour. We wouldn't have an excuse to still be sleeping, like 3 o'clock in the afternoon. He was finally awake. I decided to put him on the defensive right away. I said, "I've noticed you've been using my credit card for your ride sharing." I acted like I knew what he'd been doing right from the start. And I said, "Why would you need to use a ride-sharing company? You already own a car. You've got it parked right next to you in North Carolina. Why don't you drive your car?" He said, "Dad, on Friday nights and Saturday nights, I really like Uber." Now, there are some questions as a parent you don't push too hard on, but I kind of got it. So I decided to push him a little harder and say, because this is a kid who would never take a traditional yellow cab. I can't even visualize him hailing a cab on the street. So I said, "What do you like about Uber?" He said, "I can call the car from the bar." I said, "That's a plus." And I said, "But you have to wait forever, right?" He said, "No, they come faster than a cab." I said, "Really?" He said, "They must be much more expensive, right?" "No, cheaper than a cab." I said, cars must be filthy, right? No, they're cleaner than a cab. I said, let me get this straight. They come sooner than a cab. They're cheaper than a cab. They're cleaner than a cab. That's when I knew that cab service was destined for doom. I could see why ride sharing would take off. And then the final question I was left with was, what's so special about Uber? Why couldn't I start a ride sharing service? Why couldn't I just go down to my basement, get a really powerful computer and connect drivers to riders? And I could think of a couple of advantages that Uber had over me. One was $3 billion. They had it, I didn't. That's a little bit of a disadvantage. The second is, this is a business with networking benefits. You know what I mean by networking benefits? Which is, as a company gets larger, it gets easier to get larger because drivers want to go with the biggest ride-sharing company because that's where the customers are. And customers want the app of the biggest ride-sharing company because that's where the drivers are. As companies get bigger in this business, there's a tipping point when they're dominating the business. So my picture initially was getting an understanding of what the company did, what the competition looked like, what its competitive advantages were. Because that's the platform from which I'm going to try to tell a story about the company. Now, let me be very clear. You're telling a business story. You're not writing a creative novel. You know why I'm saying that? When you tell a business story, you want to keep it simple and you want to keep it focused. Let's take the first half of it, simple. Here's what you should not tell as a business story. I remember about 15 years ago, my oldest son came to me with a book suggestion. He said, Dad, you got to read this book. It's amazing. And I take my kids' book suggestions very seriously. He hands me this book and I pick it up and I almost fall over. It's like 1,200 pages thick. Look at the front and it says, Game of Thrones, George R.R. Martin. And I said, okay, Ryan, I'll try. And I start reading. And 2 weeks later, I called him and I said, Ryan, I'm too old for this. There are like hundreds of characters in this book. They wander on, they wander off, they die, they come back to life. They're good guys, they're bad guys. I've completely lost track of this. I give up. So my suggestion, if you're telling a business story, don't make it Game of Thrones. You don't have 8 seasons and 80 episodes to tell your story. You have like 15 minutes. Keep it simple. Second, keep it focused. What's the end game for every business? No matter how elaborate your business model is, as an investor, what do you need to convince me you've thought about? A way to make money. Is that asking for too much? That if you ask for my money, you at least have thought about the fact that you have to make money. You don't have to tell me you'll make money next year, but tell me you at least thought about the way of making money. I was watching this Shark Tank marathon yesterday, and I was watching it actively to see how many of those stories had no pathway to profitability, where the old founder said, well, I have this great business and this, how do you plan to make money? I haven't thought about that yet, but once you give me the money, then I'll think about it. Hey, you got the sequence wrong. Keep it simple, keep it focused. I'm going to try to listen to my own advice. And here was my Uber story in 2014. The reason I keep emphasizing the timing is I valued Uber every year since 2014. Do you think my story has changed over time? Absolutely. How can it not change as the world changed? But in June of 2014, here's the story I told about Uber. I described it as an urban car service company. Already I'm telling you where I see Uber succeeding, right? Big cities and towns as a car service company, which will expand the business by bringing in new users, like my son and my niece. I saw them bringing in younger users who would not have taken cabs, with local networking benefits. I already described what networking benefits were, which is as you get to be the biggest player in a city, there's a tipping point where you become the dominant player. You say, what's a local doing in here? In my story, here's what can happen. Uber can become the dominant ride-sharing company in New York. But if I fly to Chicago, I'm no longer interested in who the largest ride-sharing company in New York is. I'm interested in the largest ride-sharing company in Chicago. And in my story, Uber can take New York, Lyft can take Chicago, Didi can take Beijing, Grab can take Kuala Lumpur, and Ola can take Mumbai. You know why that matters, right? And the market share I give Uber is going to be driven by this local networking benefit. And I'm going to assume they can keep doing what they're doing in terms of business, which is not own the cars and not hire the drivers. You're going to see the story play out in my numbers, but that was the second step. So at this stage, where am I? I've understood my company. I've told a story about the company. Step 3, here's what I do. I try to make sure the story I've told you is not a fairy tale. Ask 3 questions about the story. And if it sounds like I'm playing on words, think about the words. I ask, is it possible? Is it plausible? Is it probable? Possible, plausible, probable. Lots of things are possible. A subset are plausible. So to show me something is possible, all you need to do is there's a pathway to get there. To show me something is plausible, you need to show me something more, that somebody else has done something like this. And to show me it's probable, you have to show me something you've done, even on a test market basis. We say that will work. Possible, plausible, probable. I've struggled with ways of illustrating the difference between these 3 words, but about 4 years ago, I was in Latin America, and I was doing a series of 3 cities in 3 days. I was doing Sao Paulo, Brazil on day 1, Santiago, Chile on day 2, and Lima, Peru on day 3. So on day 1, I land in Brazil. There are 300 Brazilians in the room, and I'm talking about narrative and numbers, and I'm in this slide. I'm saying, what can I ask a group of 300 Brazilians where everybody in this room will have an opinion on the topic? What's the one topic you can pick with any group of Brazilians and everybody in the room will have an opinion? Soccer, right? It was 6 months before the World Cup. I asked the question, is it possible that Brazil will win the World Cup? You ask a group of 300 Brazilians 6 months before a World Cup, is it possible that Brazil will win the World Cup? What do you think the answer was? Of course it's possible. We've done it 5 times before. I said, okay. Then I said, is it plausible that Brazil will win the World Cup? I'll tell you something. If I'd asked this question in December of 2014, the room would have been shaky. Those of you who are soccer fans know what happened in 2014, right? There was a World Cup in Brazil, and Brazil played Germany in the semifinals. Remember that semifinal? It's one of the shellacking of all times, right? 8-2. Brazilians still remember it. It's right under the surface. But by 2017, amnesia had kicked in and Brazil had risen up the ranks. They said, yeah, we're playing well. We're number 2 ranked in the world. Yeah, it's plausible. Then I said, is it probable that Brazil will win the World Cup? And now you could see the wheels start to turn. If Neymar stays healthy and we're put in the right group, and if this happens and this happens, it's probable. With each one, I was upping the ante. And I said, this works so well in Brazil. I'm going to use it in Santiago, Chile tomorrow. I should have done my homework, but I did not. So 2017, I land in Santiago, Chile, and I said, is it possible to 100 Chileans that Chile will win the World Cup? Grown men in the audience start weeping uncontrollably. I said, what the heck did I do? And it turned out that the week before, Chile had lost 2-1 to Argentina and had been knocked out of World Cup contention. I think one of the requirements to winning the World Cup is you actually have to be there. And by being knocked out, Chile was, so I didn't then have the heart to ask, is it plausible, is it probable? In other words, if you have a fairy tale, why are you wasting your time? There's some valuations where right up front, I said, this is a fairy tale. I'll sit there for politeness and somewhere in the middle of the founder will say, what do you think about my cost of capital? And my response is, I really don't care. Use whatever you want. You're in a fairy tale. You want to make it minus 50%? Go ahead. Once you've told me a fairy tale, who cares what your beta, your risk premium, your risk-free rates, all the rest of the stuff becomes almost pointless. So what I'm trying to tell you is, on your valuation, please don't tell me fairy tales, because then I'm not spending my time digging in and asking all the follow-up questions. You're saying, what kind of fairy tales? I'll give you examples of impossible stories. You tell me your company will grow 20% a year for the next 5 years. Oh, let me preface that by saying you're doing a dollar valuation. You tell me your company will grow 20% a year for the next 5 years. Okay, can a company grow 20% a year for the next 5 years? Clearly possible, plausible, even probable, depending on what kind of company you are. And then you say beyond year 5, I'm going to assume a 10% growth forever. Don't even expect me to give you feedback on this valuation. I'm going to send the whole damn thing to you and say, come on. That's all you hear, come on. You know why, right? If I let your company grow at 10% a year forever, you know what's going to happen. Eventually, your company is going to take, that is an impossible valuation. You know how many impossible valuations I see, especially from banks? I look and say, really? People paid you to do this crap? You know what a fairness opinion is? Any of you know what a fairness opinion is? John, what's a fairness opinion?
It's like an outside opinion, kind of saying that we think this valuation is correct.
And what context do you usually get fairness opinions? What's the area where you see them the most?
Shareholders are suing, saying that the company sold for too little, and they want to know.
Usually
if it was
in the
correct.
context of an M&A. And I'll tell you the history of fairness opinions. In the late 1980s, the Delaware court said that if you have a fairness opinion in an M&A transaction, shareholders cannot sue you for paying too much or selling for too little. So it's now become part of every M&A deal is there's a fairness opinion. It is one of the most useless pieces of paper known to man. And here's why. Have you ever heard of a deal that did not go through because you could not get a fairness opinion? I've never heard of one. So either every deal is a good deal, or you can get a fairness opinion for no matter what deal you do. So what I'm trying to do as a preface here is tell you that fairness opinions, I know you break all the rules. You see some of the stupidest things done in valuation in fairness opinions. So, but I cut bankers some slack because you're trying to justify the unjustifiable. You're going to bend rules. And so I'm not expecting much. So this is about 5 years ago, 6 years ago when Tesla bought Solar City. Remember that M&A deal? One of the most hopelessly conflicted deals of all time. You know why? Who's the largest shareholder in Tesla? Go along with me. Jesse, who's the largest shareholder in Tesla?
Elon Musk.
Elon Musk. Who was the largest shareholder in Solar City?
Elon Musk.
A guy called, what a coincidence, same guy, in case you're wondering. Who's the CEO of Tesla? A guy called Elon Musk. Who's the CEO of Solar City? A guy called Musk with a different first name, his cousin. So when Tesla bought Solar City, they knew they were going to get sued right and left. So they decided to buy extra protection. So they decided to get some very expensive fairness opinions. So Tesla hired an outfit called Evercore. Heard of Evercore? It's a boutique investment bank. What's a boutique investment bank? It's like, I'm not even sure what the analogy would be. They do what investment banks do, but they charge you 3 times the money. So Evercore worked for Tesla, and Solar City hired Lazard. So they both had to come up with numbers that justified the deal. So a few months later, they filed this with the SEC. The fairness opinion goes in, and I decided to read the fairness opinion. So I read the fairness opinion, and I look at how Evercore valued Tesla. This is the most horrifically bad valuation I've ever seen in my life. I mean, and that's, so that covers a lot. So here's what they've done. They've done what they called a discounted cash flow valuation. Help me out here. To do a discounted cash flow valuation, what are the 2 things you need? You need cash flows and you need a discount rate, right? So first place I looked was, how do they come up with the cash flows for Tesla? Because remember, you had to value both. There was an exchange offer, they had to value Tesla. You know where they got the cash flows? From the board of directors of Tesla. You say, how did the board of directors of Tesla get those cash flows? The board of directors of Tesla got those cash flows from Goldman Sachs Equity Research. What a tangled web we weave. Goldman Sachs was Tesla's native bank. The equity research feeds the cash flows to the board. The board feeds it to Evercore. Evercore puts it into the spreadsheet. How this is a fair or an opinion, I don't know, because you've just taken the cash flows they've given you. But I said, okay, that's lazy, extraordinarily lazy, but I'll go along. But they got cash flows for only 5 years. And after the 5th year, what did they do? They assumed a 6% growth rate forever. Remember, this is Tesla in 2016 in US dollars. My first reaction was, hey, what currency are you doing the valuation in? Maybe you switched to Argentine pesos and you forgot to tell me. But they were doing the valuation in US dollars. You know what will happen to Tesla if it grows at 6% a year, right? It'll eventually become the US economy, then the global economy, then what? Well, maybe with Tesla, you can bring SpaceX into the equation. The next thing you know, you're shipping Teslas off to Mars and Venus. And this is an impossible valuation. And how much do you think Evercore got paid for this piece of heaping garbage that they served out. $9.5 million. There is no justice in this world. If you turned in this valuation to me on April 2nd, you're definitely not getting $9.5 million. You're getting this right back to you saying, hey, you guys better fix this or this is not going to fly. $9.5 million. That's an impossible valuation. So impossible valuations, you set up an assumption that is so egregiously bad that the rest of the valuation becomes pointless. Implausible valuations can happen, but you better have a really good explanation. It's impossible. You can have growth rate in the economy. You can have a company that has revenues that exceed the entire market. I saw a valuation of Tesla last week as an automobile company with revenues of $2 trillion. No, even more than that, $2.5 trillion. The problem is the entire automobile market, even if you've got every single car was a Tesla, you wouldn't get that. That's market share greater than 100%. Or you'd see valuations where the costs get cut every year because of efficiencies, but the analyst forgets to stop and the costs get cut and cut and cut and they go to zero and they keep going. In other words, your margin just got above 100%. Impossible valuations. But what's an implausible valuation? I'll give you a couple examples. A few years ago, I valued a Middle Eastern company called Almarai. It's a Saudi dairy food processing company. And I noticed his margins were sky high relative to other Middle Eastern food processing companies. Now, usually if your margin's much higher than everybody else, especially if you're in a business where there are a few barriers to entry, you expect the competition to come in and margins to go down. So I was curious about why this company was able to keep its margins so high in the face of everybody else having lower margins. What's the competitive advantage they have? So I started checking, and one of the pages I checked was the HDS page, the largest shareholders in Almarai. And at the top of the list was somebody bin Saud, part of the Saudi royal family. You're saying, why is that a competitive advantage? Having a member of the royal family be the largest shareholder means that when you pass rules on how food is sold in Saudi Arabia, you're going to have an advantage in your favor. And once I had that, I could see why the 15% margins where they were. So in an implausible valuation, I push you, but if you give me a good reason, I'm going to say, you know what? I can get that. Or you have an infrastructure company. This actually happened about 3 years ago. Somebody was valuing a toll road company in Asia. And they had growth for the next 10 years, but almost no reinvestment. Normally, when you see growth with very little reinvestment, you push back. You say, well, how are you growing without reinvestment? So I did. And he told me a story and I stepped right back. He said, you know what, this company's been spending the last 10 years building these toll roads. The toll roads just opened last year. The growth is going to come from these toll roads being used more, but they've already spent the money. They don't need future reinvestment. I said, okay. So with implausible, I'm looking for a reason. So if any of you are telling a story that's implausible, all I'm looking for is tell me what makes this company different. And then there are improbable valuations. One of my favorite devices and one that I'm going to use in every one of your DCFs, because that April 2nd, if you turn in your DCF, because I also have an undergraduate class of about 300, there are going to be 500 DCFs that hit my email that evening. I'm not looking forward to April 2nd, 5 p.m. when all these come in. Saying, how the heck are you going to get through 500 DCFs? Because my end game is to try to get it back to you by Monday or Tuesday of the following week. Here's all I'm going to do. When you turn in your DCF, the first thing I'm going to check. So I'm going to give away the script of how I'm going to check your DCFs. The first thing I'm going to check is your growth rate. So what are the three possibilities? Your company is high growth, it has average growth, low growth, even negative growth. I'm not going to push back. It's your company. You're telling a story of high growth, average growth, or low growth. I might check to make sure your revenues don't become trillions and trillions of dollars, but I'm not going to push back on your story on that. You know, the next thing I'm going to check? I'm going to check the difference between your earnings and your free cash flow. What causes that difference? CapEx, depreciation, acquisitions, basically what you're reinvesting. And that reinvestment can be a high number, an average number, or a low number. And then I'm going to check your cost of capital. What do they say about the median cost of capital for a global company? It's about 5.5 to 6% right now. I'm going to check your cost of capital. If it's 9%, you have a high cost of capital. If it's 6%, it's an average cost of capital. If it's 4%, it's a low cost of capital. You're saying, then what? I'm going to make sure you're being internally consistent. If you have a high growth rate, what should I expect to see as reinvestment? High reinvestment, average reinvestment, low reinvestment. Generally, I should see high reinvestment, and generally your cost of capital should be higher than that 6%. High, 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 I'm going to say, okay, story is consistent. I don't know the value is right, but the story is consistent. Low, 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 it's boring, it's depressing, but it's entirely consistent. But if I see high, low, low, high growth with low reinvestment and a low cost of capital, I'm not going to tell you you're wrong, but I'm going to ask you, what is your story for this company that explains that? So with Uber, I looked at my story and asked, is it probable? Is it plausible? And because my story was a fairly not so ambitious, basically I was describing them as an urban car service company, and they were already succeeding at that. I think it passed all three tests. It was possible. I could have, if I told a much bigger story for Uber in June of 2014, if I described them as a transportation company, then the requirements for me justifying it become much higher. It's a piece of advice I give founders, because as a founder in Silicon Valley, you're now taught to tell stories. Actually, there are storytelling classes you can go to where they teach you how to tell a big story about your company, because everybody has trillion-dollar markets and all. So they said, go tell the biggest story. And I tell people, be very careful, because if you overreach on your story, the amount of defense you have to pay becomes much greater, because you're now telling a story that is pushing the bounds, and you now have to explain it. If you can explain it, great, tell the big story. But if not, you're asking for trouble. Let me close off this section by pointing to a cautionary note. Sometimes you will hear a story. So think like an investor, a VC. You will hear a story from a founder that you like so much, that you want to be true so much, that you suspend asking questions. I'll tell you what usually drives this. Usually, you have a storyteller, narrator of the story, who is charismatic and likable. Likable less so than charismatic. Charismatic. Second, they're telling a story about disrupting the world, and they're disrupting a business you don't like. So it's a business you've never liked the way it's done, and they tell you how they're going to disrupt the business. And as a bonus, they also tell you that if the story comes true, the world will be a better place. They tell you about all the social good that comes out of that story. Sounds abstract, right? So let me tell you a story, and you tell me whether you'd like this story to be true. It's about a 19-year-old who drops out of Stanford. Who does that? Well, what's Stanford's acceptance rate? Like -3% unless you're a synchronized gymnast or something. It's one of the most difficult schools to get into the world. This person got in and drops out to start a new business. You're saying, what's a big deal? Probably another tech guy starting a software. This isn't a tech guy. This is a 19-year-old woman who drops out of Stanford, and she's going to start a blood testing business. Come on, this is a business we all absolutely hate, right? Because right now, how's the business structured? You got to set up this appointment 6 weeks in advance with a lab. They extract like 2 buckets of your blood. I don't know whether Dracula drinks the blood or whether they use the blood. Takes them like 4 weeks to run the test, and then they mail you the results, so they make you see your doctor. So here's what this woman is promising. She's promising that she can do the blood test with 2 drops of your blood in a nanotainer. And the results are going to be available to you in 45 minutes. The whole thing is going to cost you less than $50. And by the way, she's going to make it available for free to parts of the world where people can't afford it. Come on, don't you want the story to be true? I didn't make up this story. This is, of course, the true story of Theranos and Elizabeth Holmes. Drops out of Stanford, starts Theranos, and it tracks a lot of VC money. In fact, by the time you get to June of 2015, they're worth almost $9 billion. And many big name VCs on them. And of course, if you're starting a blood testing company and investors investing, one of the questions you would think they would ask and get answered is, does this blood test work, right? I assumed that somebody had asked that question, but I was wrong. Because in October of 2015, a Wall Street Journal reporter decides to ask this question. does this blood test work? So he goes to the FDA and he has his Theranos approved for these 32 tests they claim on their website you can run in the blood. And the FDA says, no, they've been approved for only one, but not for the other 31. And he asks, why not? And the FDA says the tests are a little noisy. You know what a noisy test is, right? Trust me, you don't want a noisy blood test. It comes back and it says you could be sick, you could not be, don't worry too much about it, just let it go. And he writes a story about it. Theranos pushes back, threatens to sue the Wall Street Journal. But over the next 6 months, the entire story unravels. It turns out that they've been cooking the test. They've been running these tests on equipment that didn't even belong to them. They were making up results. 6 months later, you know what the pricing for Theranos was? It was back down to zero. And one of the big questions was, where was the board of directors while all of this was happening? So I took a look at the board and I saw almost instantaneously why nobody was asking a question. You know what? When I looked at this board, my reaction as I saw the names was, he's still alive? Him too? George Shultz. You know, George Shultz was Secretary of State under Ronald Reagan in 1981. Henry Kissinger, what the heck is he doing on a board of directors for a blood testing company? Maybe he's talking about the Iron Curtain. And my cynical side said, if you're a CEO, a megalomaniac CEO, and remember, megalomania is not just restricted to middle-aged men. You can have a 25-year-old woman with megalomania. And you never want to be asked a question. Here's a very good strategy to adopt. Get a bunch of 80 to 90-year-olds, put them on your board of directors. Call for a board meeting, put some pillows in front of every chair, 80 to 90, fall asleep all the time. Have a backup ambulance. You're probably never going to be asked a question. This is a runaway story. And because runaway stories are so built around personalities, that when that personality develops feet of clay, guess what? The whole story comes apart. If you get a chance, read my post on WeWork after the implosion. Because Adam Newman, this in my view was the first company that came out of a TEDx talk. You know that WeWork was created out of a TEDx talk. Adam Newman, charismatic, runaway story, SoftBank bought into the story, $60 billion presumed market cap, and then the whole thing unraveled. Be very careful when you fall in love with the story, because when you fall in love with the story and you really want the story to be true, it's amazing how quickly you stop asking questions. So let's stop there. We will pick up with the rest of the storytelling part, but start thinking about the story for your company and running it through these tests, because this to me is when valuation gets to be fun. It's interesting because you're not talking about the numbers, you're devising a story for your company. And remember, the story for your company could be a horror story. If you're valuing Carnival Cruise Lines, don't expect a happy ending. There's no prince on the horizon. This is a story where the end game is like Friday the 13th. There's going to be a lot of blood in the ground, and it's probably going to be your company's blood. So don't try to make the story have a happy ending, especially if it's a company that doesn't deserve it. So we'll talk more about this on Wednesday. So let's see you then. If you have questions, or can I hang around for a couple of minutes because I've run to my next class. So.
Hi, Professor. I have a quick question.
Yeah.
It's a question about the slide you showed about the value narrative. I wonder whether like companies like Google are able to demonstrate both high growth and low reinvestment because it's a platform company.
They have it in their past, right? So.
Yeah, so I'm just wondering. I'm wondering whether or not they can continue.
That's up to you to decide, right? So they stay in the search engine box. There's not much reinvestment needed to keep that box going.
Yeah. Okay.
But to the extent that that business is running out of growth, the online advertising business is now dominated by Google and Facebook.
Mm-hmm.
You no longer have the easy money to make where you're pulling revenues from the New York Times. Those days are done. The traditional advertisers have shrunk. So this is now going to be a profitable business, but a low growth business. So where's Google looking for future growth? It's looking at electric cars. It's looking at phones. It's a very different business. So when you think about what can it continue, it depends on what you think the story for Google will be in the future. Where does it go?
Okay, thank you. That makes sense. Thanks so much.
Professor, can I ask your opinion on something for a minute?
Sure.
Okay, so I have a friend who has a YC company, and when all of them pitch to venture capitals, they use this fancy PPT template that Uber and Airbnb and everyone has been using. And the constant argument that we keep having is that I find it odd that it's a valuation without an Excel sheet.
It's a pricing. So that's the first thing, is they're not looking for a valuation, they're looking for a pricing.
Mm-hmm.
And the template is built around feeding into that pricing metric and what people are paying in pricing. So that's why the story can be sloppy and half done and still be priced, because if you're pricing based on revenues 3 years from now, all you have to do, or price even worse on users 3 years from now, all you have to do is show me that your model can deliver 3 million users in 3 years. And next thing I know, I'm paying $100 per user and you've got a pricing for your company. So if you want to do a true valuation, it requires more work. You've got to convert this template from the metric you built it around to actually building a business model.
Got it.
But
Thank
why
you
would you
very
ever
much.
do it? If people keep paying the pricing, there's no incentive to really do this, right?
So do you think in that context, Stripe is a fairy tale?
What's a fairy tale?
Stripe, with their 95
Stripe,
billion.
I think, has a basis, right? Financial services, we're just starting to see the game start to change because it's a huge, huge business. That's what Stripe is going for.
Yeah.
The question is, what happens? First, you got to make some assumptions about what the status quo looks like and how they will try to react. And the second is, you got to ask, what does Stripe do that is unique and different? Is there a networking benefit in this business? I mean, for instance, I think Venmo is an amazing business model. It's a model that is built around connecting social media to payments, and it's become very successful. So some of these models are going after really big markets. That's a plus. But these markets have traditionally been markets where the margins are really slim. So whatever story you tell us is to give me huge transactions to start delivering profits for me.
Mm-hmm.
So I think Stripe has a basis, just like Square. I think Square is a much better company than Twitter, for instance, because it's going after a market that's huge and it's a business model that will actually start to deliver economies of scale. So I'm not willing to knock Stripe off. I don't know whether it's worth what people are paying for it, but clearly there's a big story to be told and a big value that comes out of that story.
Great. Thank you very much for your time.
You're welcome. I've got to leave because I've got another class in